If your sales changed last quarter, could you confidently explain why? And by that, I mean not just guess, but actually break down what drove it, how strong those drivers are, and what to do next. That's exactly what the tool I'm about to show you helps you do. Hi, I'm Senan. I work in forecasting and data analysis, building models that explain performance and support business decisions. Now, let's jump right in using a real data set. So let's start with a data set. And the structure is simple. We have one date column, which is week start, and one KPI column, which is sales. We also have multiple drivers, and those drivers fall into four groups. The first group is marketing, and that includes TV, search, social, and email spend. We also have the business levers, and those include promotions, holidays, and pricing. The third group is external factors, and in this case, that's competitor spend. And then the fourth group is the contextual factor. In this case, that's region. And one thing to note here is that region is a categorical variable, so the model captures structural differences across markets. Now, this is a very typical setup. There is one outcome, which is sales. There are multiple drivers and everything moving at once. So the question here is simple. What is actually driving sales? And that's something that we will answer using the growth driver analysis tool. So we start by first going to the tool by clicking the Growth Driver Analysis tab. And then we need to bring in our data set. To do that, we'll have to click the Browse File button located right here, and then select the data set that we want to bring in. In this case, I want to bring in the data set 2 for MMM regression, and select that, bring that in. The tool automatically shows you information about your data, like how many rows it has, the number of columns, the number of numeric fields, as well as the number of categorical fields. Next, we define the model. And to do that, we need to scroll down here, and we can choose our date column, which is week start. We can choose the independent variables, which are TV spend, search spend, social spend, email spend. I'm going to include region, promotion flag, holiday flag, competitor spend, price index. And then actually, I want to make sure I'm choosing the proper dependent variable. That's what we are trying to explain. And in this case, it's sales. So here I've chosen my date column, the dependent variable, and the drivers. And something else I can do here is choose the number of drivers I want the tool to take into account. The tool allows a maximum of 9 drivers, so that's what I'm going to do. If I wanted to, I could include seasonality or apply ad stock, but we'll leave that for another time. We can also include feature selection settings. We can choose stepwise regression or lasso regression, but I'm going to leave those out for now. And then we click Run Analysis. So in this section, what we've done is basically define our model. Now, here in the executive view, we have a high-level summary of the model. The R squared of 0.86 tells us that the model explains 86% of the variations in sales. The MAPE of 3% tells us that this model has strong prediction accuracy. So this is a usable model, not just an experiment. And the top drivers in this case are TV spend, search spend, and social spend. And something very important to keep in mind is that these are the drivers that matter after controlling for everything else, not just what is correlating with sales, but what is actually driving sales. Now, let's take a look at the model results. Here we go a bit deeper into the model output, and each variable has a direction, a strength, and statistical significance. That's what the first coefficient table shows us. For example, search and TV have a strong positive impact, while price has a negative impact. And that's what we are able to really see here. So the great thing with this model is that the impact is quantified and not just assumed. Something else that's great data to look at, a great table here, is the contribution table, because this shows where the sales is coming from. For example, TV is contributing 27.52% of sales, search is contributing 26.6% of sales, while social is contributing 15% of sales. Emails is also contributing to sales, roughly 8%. That's smaller, but still meaningful. And this really tells you what is actually driving revenue. So the diagnostics and chart tabs help validate the model. In the diagnostics tab, we can look at multicollinearity for different variables. This is where we can run multicollinearity checks. And we also have a correlation matrix tab that shows the correlation of different variables to each other, different independent variables to each other and to the dependent variable. We are also able to check residual behavior in the chart tab and look at the differences between actual versus predicted sales. So these are really great tab to look at to help validate the model. Then let's move on to the scenario planning tab, because this is where you can move from analysis to decision. Let's say we reduce social spend by 10%. Let's do that. And let's run the scenario. What we notice once we do that is that sales drop by about 1.5%. So this is really where you can test decisions before making them. Now, let's move to the ROI optimizer tab, because this is where it becomes a decision engine. You can set a total budget, apply different constraints to some of your drivers, and this can help you reallocate spend across different media and evaluate the impact on return on investment. For example, you can increase TV and search or adjust social and email, then compare the baseline with the baseline ROI with the optimized ROI. So this is where you can move from analysis to a real spend allocation strategy. Another feature of a model is the diminishing return analysis, because this can help you evaluate saturation across different drivers. We can select whichever drivers we want to look at, and it updates to tell you how performance changes as spend increase. So let's go back to TV. For example, for TV, performance will continue to increase as spend increase, but you will see that the marginal return declines. And what this means is that each additional dollar is less effective, and this is critical to avoid overspending. Then we also have the forecast feature. where we can project forward based on how our variable look in the current model. I can forecast however many periods I want into the future based on the current variable, and this become a real explanation tool and also a forecasting system, because this tells you if you keep going the current course with your current budget allocation, this is what you can expect over the next 12 weeks, since in this case we are looking at our data at a weekly level. So overall, this model is really the difference between having data and understanding what's actually driving your performance, as well as what to do about it. One thing I want to point out is that nothing is saved during your session, so you will need to export all of your data, because the goal is to make sure that people feel comfortable uploading their data, running their analysis, and then downloading the output by just going to the Export tab and clicking Download Full Excel Output. Thank you for watching. If this was useful, please consider subscribing to our channel at MeeleWorks. I'll be sharing more tools like this and breaking down how to turn data into real decisions.